When beginners enter the stock market, they often have questions about which stocks to invest in. Such questions can overwhelm even a seasoned investor. Stock market investors must have sufficient knowledge to determine which stocks are the right choice for their investment strategy. If you have no clue about which stocks you should put money in, you could face losses. The share market has inherent risk, and this risk varies from one stock to another. Stocks in the stock market are often classified based on their market capitalization, or market cap, as large cap, mid cap, and small cap stocks. This categorization helps investors to make informed investment decisions. This video will help you to understand the differences between large cap, mid cap, and small cap stocks, and help you decipher which ones you should invest in. Welcome back to another episode of Living Fire. If you never want to miss an upload, make sure to subscribe to the channel. Market capitalization, meaning and categories. Market capitalization refers to the total number of outstanding shares of a company in the market, multiplied by the current price of each share. It is a measure of the estimated valuation of a company. The companies that are traded on the stock exchanges can be categorized into three broad categories: large cap, mid cap, and small cap. Let us learn about each of them in detail. What are large cap stocks? Large cap companies are businesses that are well established and have a significant market share. Large cap companies have market caps of 20,000 rupees crore or more. These companies dominate the industry and are very stable. They hold themselves well in times of recession or during any other negative event. Besides, they will usually have been functioning for decades and have good reputations. If you want to invest in a company's stocks by taking less risk, then large cap stocks are a good option. These stocks are less volatile in comparison to mid cap and small cap stocks. The lower volatility makes them less risky. Reliance Industries and Infosys are examples of some large cap market companies that are listed on the Stock Exchange of India. Their strong foothold in the market and consistent good performance makes them good choices for long-term investors. What are mid-cap stocks? Mid-cap companies are companies whose market cap is above 5,000 rupees crore, but less than 20,000 rupees crore. Investing in these companies can be riskier than investing in large cap market companies. This is because mid-caps tend to be more volatile. On the other hand, mid-cap companies also have the ability to turn into large cap companies in the long run. These companies offer a higher growth potential than do large cap stocks, and hence more investors are attracted to investing in such companies. Metropolis Healthcare, Castrol India, and LIC Housing Finance are some examples of mid-cap companies that are listed on the stock exchanges of India. What are small cap stocks? Small cap companies are those that have a market capitalization of less than 5,000 rupees crore. These companies are relatively smaller in size and have significant growth potential. What makes them risky is the low probability that they will be successful over time. This makes the stocks of such companies volatile in nature. Small cap companies have a long history of underperformance, but when an economy is emerging out of a recession, small cap stocks often prove to be outperformers. Difference between large cap, medium cap, and small cap companies. Company type and stature. Large cap companies are companies that are big and well established in the equity market. These companies have reliable management and rank among the top 100 companies in the country. Mid cap companies sit somewhere between large cap and small cap companies. These companies are compact and rank among the top 100 to 250 companies in the country. Finally, small cap companies are much smaller in size and have the potential to grow rapidly. Volatility. Your investment risk in the stock market is closely related to volatility. If the price of a stock remains reasonably stable, even in turbulent markets, it means the stock has low volatility. On the other hand, stocks that see significant price fluctuations at such times are termed as highly volatile. The stocks of large cap companies tend to be less volatile, which means their prices remain relatively stable, even amid turbulence. This makes them relatively low-risk investment options. Mid-cap stocks are slightly more volatile than large cap stocks and carry somewhat more risk. Small cap companies are highly volatile and their prices can swing considerably, which increases the risk for investors. Growth potential. The growth potential of large cap stocks is lower than that of mid cap and small cap stocks. That being said, large cap stocks are a stable investment option, especially if you have a longer investment horizon. This makes large caps well suited to investors with low risk appetites. If your risk appetite is moderate, you could look into mid caps, as these have a slightly higher potential for growth. The highest growth potential lies within small cap stocks, but you should invest in these only if you have a high tolerance for risk. Liquidity. The term liquidity means that investors can buy or sell large cap shares quickly and easily without affecting the share price. Now, large cap stocks tend to have higher liquidity, as there is a high demand for large cap shares in the stock market. Thus, squaring off positions is easier when you purchase such shares. In comparison, mid-cap companies have lower liquidity, as the demand for their stocks is slightly lower. Small-cap companies have the least liquidity, which can make squaring off positions more difficult. Mutual funds and market capitalization. Mutual funds are an integral part of the Indian financial system. Mutual fund schemes are categorized into large cap, mid cap, or small cap funds based on their investment allocation. For example, a large cap mutual fund scheme will mainly invest in large cap stock, while mid cap and small cap schemes will invest in mid cap and small cap stocks respectively. How do you choose the right mutual fund scheme for your investment portfolio? A part of your decision-making will depend on your tolerance for risk. Large cap funds will generally be the less risky option, whereas small cap funds could carry a higher potential for growth. But before you start looking into such mutual fund schemes, it is important to understand the differences between them in terms of risk. Differences between large cap, mid cap, small cap funds in terms of risk. Risk in large cap funds. Large cap funds invest mainly in blue chip companies. Such funds inherently have certain advantages. The companies they invest in are large and stable businesses with the capability to weather market volatility. There is a high demand for these stocks, which makes them highly liquid. Their growth potential may be low, but so is the risk. And these funds generally bring modest but consistent returns over the long term. Risk in mid-cap funds. These mutual funds invest mainly in mid-cap stocks. This brings a slightly higher potential for growth, and thus the possibility of relatively higher mutual fund returns. However, the possibility of risk is higher as mid-cap companies are less able to cope with market volatility than are large caps. The goal for the fund manager is to allocate funds to mid-cap companies that could be successful in future. Risk in small-cap funds. The investment focus of these mutual funds is on small-cap companies. The risk exposure is higher with these funds, as small-cap companies are not well-established businesses. They may struggle to stay afloat during a recession, for example. But when a small cap does well, the possibility of growth is higher than for mid-caps and large caps. Small-cap funds try to tap into this possibility. Despite the higher risk, there is a possibility of relatively higher returns. Role of market capitalization in your portfolio. Market capitalization can play a significant role in your investment portfolio. As the share market passes through different phases, the performance of large, mid, and small cap stocks keeps changing. When large caps are not doing well, mid and small caps could be on the rise. And when mid or small caps are plummeting, the large caps in your portfolio could steady your overall returns. So it is important for stock and mutual fund investors to diversify their portfolio by investing across market caps. It will help your portfolio to tide you over during changing market conditions. Just make sure to factor in your financial goals, appetite for risk, and investment horizon before investing. Also keep in mind that investing in the share market or in mutual funds requires research and analysis. And with that, we've reached the end of this episode, all about large cap, mid cap, and small cap stocks, and which ones you should invest in. Do you invest in any of these stocks? If so, which ones? Get involved and let us know in the comments section down below. If you enjoyed this one and found it helpful, remember to leave a like on the video and to subscribe to Living Fire for even more amazing videos just like this one. Thank you for watching, and we'll see you in the next one.